Hey folks, it's Serge here. I am still working from my summertime cabana here as we go into August, and I wanted to update you guys with one chart that is rather concerning and I think quite telling for the broader market. And the second one is actually quite bullish, and I do actually think it reflects the environment that we've moved into. And so let's just look at that very first chart. And what we're looking at here is regional banks. Now, for some of you guys that follow the bond market, we have actually moved into an environment where bonds were once again actually correct, I think, to a good degree, that we're going to see growth slow down to some extent, still from very good levels, but inflation remains somewhat sticky. And what that basically means, and this is unbelievably important, and if you don't know what this is, maybe have a look on Google quickly what that means, but real bond yields are likely going to be negative to even more negative, and that's actually beneficial for something like gold. But it's also not very good for something, well, it's good for gold, but not very good, let me be clear, for something like banking stocks, regional banks being sort of the bigger issue there. So this is one of the parts of the market that we focused on quite a bit as we moved through the first and second quarter of 2021, where there was a lot of growth, good inflation numbers, and regional banks were doing very well. They have since actually broken below what used to be a breakout line that we actually broke out above in March of this year, but we've since broken down below. Now, I don't think there's a massive amount of downside, but I also don't think there's a ton of upside. So to me, this could be a bit of dead money, and not until we see this part of the market pick back up again, which we could see in the fourth quarter of this year, do I really want to be involved here. So I think regional banks, the KRE ETF, is one that we want to avoid for right now. And I'll even quickly show you the daily chart for those of you guys that are moving average people. You look at the 50-day moving average slicing, that's the yellow line slicing below that blue line, that's the 100-day moving average. It's just one thing to watch, but we can see that we're starting to, we have broken that sort of real digestion period where the path, at least resistance, still looked to be the upside. We're now finding support at the 200-day moving average. I think that may or may not hold, but I just don't think there's a lot of exposed upside. That's really why I want to be watching this very, very, very closely for the coming weeks and months. On the other hand, something that is looking very good, and those of you guys that have been following us for years and years, you know we've always been a little bit skeptical, not in terms of the story behind it, but in terms of the implied volatility. And when I say implied volatility, I don't mean implied volatility in terms of the options, but the inherent volatility is probably the better word of using, of being involved in something like Tesla as a stock. But let me show you where this stock is, and I'll give you some fundamental ideas here as well, why we like this. And I'm going to get rid of a couple of things here so this doesn't look too colorful. But what we're looking at here is I made this a longer term weekly chart, or actually I'm going to make it a weekly chart. We're using logarithmic numbers here, a logarithmic chart. Okay, and so basically what you can see is that even though the stock has had an unbelievable growth spurt, Tesla has essentially done nothing this year. Like, it's actually down for the year for the most part, but it's essentially consolidated. Now that's the technical part of it, and you can see it's actually now breaking out to the upside, or at least trying to. Wouldn't be surprising to see this stock hold up relatively better and ultimately accelerate later on this year at some point and start making fresh all-time highs. Now that's the technical part. Let me give you an idea of why I think this could happen from a fundamental perspective. I think our work suggests that as we get into the second half and into the fourth quarter and of course beyond, that story of electric vehicles is only going to accelerate. From what we're seeing, that story, a lot of people think electric vehicles are going to be slow to adapt. We think it's going to be adapted much quicker than a lot of people think. There's a lot of smart analysts thinking it's coming quick as well, but I think the broad base of the investor base doesn't understand, or is on the side of this being adapted slower than what we think is likely to happen. So something like Tesla, could actually act very well, perversely, because it is a growth name, but also because it is a true growth story, at least the way we look at it. So there you have it, a couple things to look at here in August and beyond for now, where we think Tesla looks pretty good, and something like regional bank, which more of a macro tell, could actually be a bit of a struggle, but at some point may pick up again later on this year. Hope this is helpful. Let us know if you like this. Comments, thumbs up, like, and we will see you in the next video. Take care.